Not all commodities are going up. Some will become strategic assets. Others will stay cheap forever. And the difference between those two outcomes has nothing to do with demand forecasts, inflation headlines, or price charts. It has to do with whether the world can function without them. That's the mistake almost everyone is making right now. People talk about commodities as if they're one thing, as if copper oil, wheat, silver, iron, ore, and lithium all live in the same universe. They don't. And over the next decade, that misunderstanding is going to cost a lot of people time, capital, and confidence, because commodities are about to split in two, and most people will end up on the wrong side of that split without ever realizing what went wrong. Let's start with the belief that got us here. For years, people were taught that commodities are an inflation hedge. If prices go up, commodities go up. If money loses value, hard assets win. That logic worked once. It doesn't anymore. Not because inflation is fake, not because commodities don't matter, but because the system that consumes commodities has changed. Inflation is broad. Commodity outcomes are not. Some commodities have become critical to the functioning of the system itself. Others are just inputs that can be replaced, delayed, substituted, or ignored. Treating them the same is the fastest way to get stuck holding something that never goes anywhere. Now, here's the uncomfortable part. Most people who think they're diversified into commodities aren't diversified at all. They buy broad commodity exposure. They buy baskets. They buy themes. And what they actually own is a mix of things that will matter enormously, combined with things that will quietly decay. The winners carry the losers. And over chimi, the losers dominate. This is why so many people say commodities never work. They do work, just not all of them. And not at the same time. The coming decade is not about being bullish on commodities. It's about being selective, because the world is entering a phase where scarcity matters more than growth, and scarcity does not apply evenly. Let me make this simple. A commodity's future no longer depends on how much of it is used. It depends on what happens if it's not available. That single question changes everything. If a commodity disappears and nothing breaks, it's not strategic. If a commodity disappears and systems fail, policies change, and governments intervene, it is. That's the split. And it's already happening. Most people don't see it because they're looking at price. Price is the last thing to move. Before price moves, behavior changes. Governments start paying attention, industries start locking supply, substitution attempts begin and quietly fail. And by the time price reflects reality, access is already gone. So let's talk about what actually determines which commodities matter now. Not narratives, not charts. Structure. There are 4 filters that decide whether a commodity survives this cycle or fades into irrelevance. If a commodity fails, even one of these, it's vulnerable. The first filter is not useful, not popular, essential. If the commodity disappeared tomorrow, would the system keep working? Could energy flow? Could transportation function? Could data move? Could defense operate? If the answer is yes, it's not essential. If the answer is no, it immediately belongs in a different category. The second filter is substitutability. Can the commodity be replaced quickly, cheaply, or at scale? Not in theory. In reality, engineers try to substitute everything. They only succeed sometimes if substitution degrades performance, increases cost, or introduces risk. It doesn't count. A commodity that has no realistic substitute becomes far more valuable under stress. The third filter is supply elasticity. If demand rises, can supply respond quickly? Can production be ramped without years of investment, political approval, or geological luck? If supply can expand easily, scarcity doesn't persist. If it can't, pressure builds. And pressure is where repricing begins. The fourth filter is political sensitivity. Does the commodity attract government attention when stressed? Do policymakers intervene when prices rise? Do they subsidize, restrict, or prioritize it? If governments care, it's because failure is not an option. Now here's the critical insight. Most commodities fail at least one of these filters. Some fail all 4. And those commodities do not benefit from inflation. They stagnate, they disappoint, they quietly waste time. Let's make this real with an example. You bought a broad commodities ETF. You didn't want to pick winners. You wanted protection. Inflation rose. Energy prices moved. A few metals rallied, but agriculture lagged. Industrial materials underperformed. Some commodities went nowhere. Years passed. Your thesis wasn't wrong. Your outcome was because diversification diluted scarcity. You owned too many things that didn't matter. And the things that did matter weren't allowed to fully express it. That's the trap. Broad exposure feels safe. In reality, it guarantees mediocrity in a world that's becoming more polarized. Now let's draw the line clearly. There are 2 commodity worlds forming. They behave differently. They are priced differently. And they are treated differently under stress. The first world is strategic commodities. These are commodities the system cannot function without. They sit underneath energy, defense, infrastructure, and monetary trust. When supply tightens, behavior changes, contracts get signed, governments intervene, rules adjust, prices don't just rise. They become secondary. Access becomes the priority. These commodities are not priced by demand curves. They are priced by urgency. And urgency does not care about valuation models. Now, here's a human example of how this plays out. You didn't chase consumer stocks. You didn't buy trendy narratives. Instead, you own exposure to energy inputs. Energy prices rose. Volatility increased. But something important happened. While others complained about costs, you weren't forced to react. Your heating bill went up. Your portfolio absorbed it. You didn't feel smart. You felt insulated. That's the difference. Strategic commodities don't make you rich overnight. They make you resilient when conditions tighten. And resilience compounds. The second world is non-strategic commodities. These are commodities that matter until they don't. They're oversupplied. They're easily substituted. They're politically ignored. When demand slows, they drift. When supply rises, they stagnate. They don't collapse dramatically. They decay. And decay is far more dangerous than collapse, because collapse is obvious. Decay convinces you to wait. Here's another example. You bought iron ore because it looked cheap. China was growing. Infrastructure demand seemed endless. Then growth slowed. Supply stayed high. Years passed. Nothing catastrophic happened. Nothing good happened either. You weren't wrong. You were irrelevant. That's what non-strategic commodities do. They don't destroy you. They just trap you. And time is the most expensive cost of all. This is why the coming split matters so much. Because the system is moving away from abundance and toward constraint. And constraint does not reward everything equally. It rewards the things that cannot be replaced. It punishes everything else with indifference. Now, pause here for a moment. Notice what I haven't told you. I haven't said all commodities will surge. I haven't said this is a supercycle. And I haven't said timing is easy. Those stories are comforting. They're also wrong. This cycle will not lift everything. It will expose differences. And those differences will widen over time. Which brings us to the most important shift you need to make. Stop asking which commodities are cheap. Start asking which commodities cannot be ignored. Cheap can stay cheap forever. Ignored is terminal. In the second half of this video, we're going to get practical. We'll walk through how to filter commodities correctly, how to position without overreaching, and how people who made the right choices didn't get rich overnight, but also didn't get trapped when conditions changed. Because in this cycle, the goal isn't to win everything. It's to be on the right side of the split. Like, subscribe, and let's continue. Now that you see the split, the real question becomes practical. What do you actually do with this understanding? Because knowing that commodities are diverging is useless if you respond the same way people always do. Most people hear this and immediately ask, which commodity should I buy? That question misses the point. The correct move in this environment is not picking a winner. It's avoiding the wrong category. The fastest way to lose the next decade is to tie your capital to commodities that feel necessary, but aren't. So instead of chasing what's popular, you need a process, a filter you can apply calmly, without hype, without urgency, and without perfect timing. Here's how people who didn't get trapped actually behaved. They didn't try to predict price spikes. They didn't chase momentum, and they didn't expect quick payoffs. They asked one question over and over. If this commodity became scarce tomorrow, what would happen next? Would governments step in? Would industries panic? Would substitution quietly fail? Or would the world simply adjust and move on? That question alone eliminates most of the market. Now, let's make this concrete. Imagine two people entering the same environment. Both believe inflation is coming. Both want protection. Both want to be early. The first person buys broad exposure. They want safety in numbers. They buy a commodity basket. They buy hard assets. They buy the idea of scarcity, what actually happens. A few components perform. Most do not. The underperformers don't crash. They stagnate. Years pass. Their thesis was right. Their outcome was flat. They didn't lose dramatically. They lost quietly. Now look at the second person. They don't buy everything. They narrow aggressively. They ask which commodities are so critical that failure would force intervention. They accept volatility. They accept boredom. They accept long periods of nothing happening. And when pressure appears, something different happens. Instead of panic, there is a response. Supply gets prioritized. Capital gets redirected. Rules change. Not to help investors, to keep systems running. That's the difference. The second person didn't win. They avoided being irrelevant. And that's what matters. Now let's talk about positioning without overreach. This is where most people sabotage themselves. Once they identify strategic commodities, they immediately try to maximize exposure. They concentrate, they leverage, they rush, and they turn a structural advantage into a timing problem. That's how good ideas fail. The people who did this correctly treated strategic commodities as anchors, not lottery tickets. They didn't expect explosive upside. They expected durability. They sized positions so volatility didn't force decisions. They didn't borrow against them. They didn't depend on them to perform on schedule. And because of that, they stayed invested long enough for structure to matter. Here's a simple example. You allocated part of your capital to energy-related inputs, not because they were cheap, not because you loved the narrative, but because the world cannot function without energy. Prices moved around. Sometimes they fell. Sometimes sentiment turned negative. But something important never happened. You were never forced out. When energy costs rose, your exposure softened the impact. When volatility hit, your position absorbed stress instead of amplifying it. You didn't feel like a genius. You felt stable. That's the payoff. Strategic commodities pay in resilience before they ever pay in returns. Now, let's talk about what not to do, because this matters just as much. Do not assume demand growth alone creates opportunity. Demand without constraint creates competition. Competition destroys margins. If everyone can produce more, prices won't protect you. Do not assume cheap commodities are cheap often means irrelevant. The market is very good at ignoring things that don't matter. Do not assume technological progress eliminates scarcity. Technology shifts demand. It rarely removes the need for critical inputs. And do not assume governments will let markets resolve shortages naturally. They won't. They intervene when failure threatens stability. This is why political sensitivity is such an important filter. If a commodity becomes scarce and nothing happens politically, it's not strategic. If it becomes scarce and rules change, it is. Now let's address the emotional trap that catches almost everyone: waiting. People wait because they want confirmation. They want prices to move first. They want headlines. They want consensus. But by the time those things appear, the split has already widened. Strategic commodities will already be prioritized. Non-strategic commodities will already be ignored, and reallocating becomes painful. This is why the people who did best didn't look early. They looked boring. They held positions that didn't excite anyone. They didn't argue online. They didn't explain themselves. They just waited. And when conditions tightened, they weren't scrambling. They were already positioned. Now, here's the most important realization of all. This split is not temporary. It's structural. It's driven by constraints that are not going away. Energy transition, infrastructure strain, geopolitical fragmentation, security priorities, all of these favored inputs that are essential, scarce, and difficult to replace. And they punish everything else with neglect. That neglect is not dramatic. It's patient. And patience destroys capital more quietly than crashes ever could. So ask yourself this: if the next decade is defined by constraint instead of abundance, which side of that split are you on? Are you holding things that will be fought over, or things that will be ignored? Are you exposed to inputs that systems protect, or to commodities that drift until you give up? Because the market will not tell you when this matters. It will simply behave accordingly. And one day you'll look back and realize the difference wasn't intelligence. It was selection. Most people will say commodities disappointed them. A few will realize they were holding the wrong ones. And that realization will change how they approach every cycle that comes after this. This is not a call to rush. It's a call to be deliberate, to stop thinking in themes and start thinking in structure, to stop asking what might go up and start asking what cannot fail. Because in a world defined by constraint, the future belongs to what the system cannot afford to lose. Everything else is noise. And once you see that, this split becomes obvious, quietly, permanently,